Here's today's Money Metals Minute, brought to you by MoneyMetals.com. Gold and silver dropped sharply Friday as rhetoric from Fed officials about a supposedly strong case for interest rate hikes. But America's central bank made little comment regarding the recent disappointments on jobs, manufacturing, and GDP. Equity markets also got hit Friday with the Dow losing nearly 400. That's the largest drop since the Brexit roiled the markets. The bulk of July and August were characterized by light volume trading and extraordinarily low volatility in most markets. Now here's a special report from Mike Gleason of Money Metals Exchange.
Precious metals investors must contend with uncertainty surrounding the economy, the upcoming election, and the timing and direction of the Federal Reserve's next policy move. The Fed meets September 20th and 21st to decide whether to keep stimulating the stock and bond markets. Propping up financial assets may not be the Fed's stated purpose, but it has been the major effect of its ultra-low interest rate policies and bond buying campaigns. On Wednesday, the Federal Reserve released its Beige Book report. The Beige Book consists of economic data from each of the 12 Federal Reserve districts. It is used by Fed policymakers to gauge the health of the economy. Cynics might charge that the Beige Book offers Fed officials anecdotes to help them spin whatever broader narrative they want to push. Lately, Fed officials are pushing the narrative of moderate economic growth and a tightening jobs market.
Labor conditions tight. You know that the Fed has a dual mandate. They've got monetary policy and, of course, the employment picture. That doesn't seem to me like they can make the case for a raise right now.
Look, this Fed is confused. It does not know what it's doing. It doesn't have a playbook. It's sowing confusion within each speech that they do. On one hand, they say labor market conditions are tight. On the other hand, they say the economy is modest.
I think modestly is probably about the rule of the day here, which to me means that the Fed's off the table prior to the election, but maybe on it for December.
If the economic picture really is as robust as the Fed paints it, then the central bank should be raising rates. But of course, Janet Yellen and company don't want to risk triggering a stock market meltdown before the election. Some polls now show Donald Trump running even with Hillary Clinton among likely voters. That's making a lot of people in Washington nervous, including Fed officials. So they've come up with excuses for why they can't raise rates just yet. The most convenient one is that the official inflation rate hasn't yet risen to their 2% objective. But by the time official inflation does hit 2% year over year, real-world inflation will likely be running significantly higher. Right now, the bigger problem in the economy, and one that is constantly being covered over with suspicious statistics, is the fact that millions of Americans remain out of work or stuck in low-paying jobs. Some 7 million men aged 24 to 54 have statistically disappeared from the workforce because they have been jobless for so long. The Fed touts steady increases in job openings as evidence that businesses are looking to hire. But that doesn't mean they are actually hiring. Job growth continues to lag behind as the workforce participation rate remains mired in the dumps. The Fed also must contend with the fact that other major central banks around the world are intent on holding rates down and pursuing stimulus schemes. The European Central Bank on Thursday opted to leave its key interest rates unchanged near zero. The ECB recommitted to 80 billion euros a month in asset purchases at least through March of next year. The euro has actually shown some modest strength this year. A brief post-Brexit sell-off didn't turn into a crash, and the euro has since crept back up versus the dollar. The U.S. dollar index is down modestly year to date, though its low point was reached back in May. For now, the dollar remains range-bound. Even if we don't get any major moves in the currency markets anytime soon, precious metals can still trend on their own momentum. National currencies only rise or fall versus other currencies. It's a zero-sum game. By contrast, physical metals can gain in terms of dollars regardless of whether the dollar is gaining versus other currencies. Over time, all fiat currencies tend to depreciate versus hard assets. In other words, gold and silver can be expected to rise in value in terms of every fiat currency.
And that was Mike Gleason at MoneyMetals.com. Live prices at moneymetals.com show gold currently trading at $1,326.80 per ounce on the global market. Silver at $18.84.